President-elect Donald Trump doubled down this morning on universal tariffs, saying on Truth Social, the Washington Post wrongly reported potential plans to target specific sectors. Now, that comes after this morning the Washington Post had reported that tariffs would be universal to every country, but would only impact certain items. We want to get some perspective on this from a former member of Trump's economic team, Joseph LaVorgna, SMBC Nikko Securities America managing director, also former chief economist at the National Economic Council. Great to have you on with us, Joseph. I just want to get your sense, given that you have had these kinds of conversations with the incoming president. Do you think there was truth to the Washington Post reporting?
No.
Tell me more.
No, I don't. I mean, the thing isn't because, look, President Trump's been very clear on what he wants to do with tariffs, and he said some minimal level of tariffs, 10 to 20% across the board, and China at 60. Those numbers are obviously can change, but to come out and say that we're not going to be as high as what he'd been saying and it's going to be targeted is definitely putting the cart way in front of the horse. So when I saw that story, I said that didn't make any sense to me, and certainly President Trump admitted as much.
Joe, what do you think of the market's reaction, though? It seemed like the market was a little bit encouraged by what we heard from the Washington Post report.
I mean, it depends what market. I mean, the equity market is still up pretty significantly today because the market's excited about inflation coming down and growth being a lot stronger. The bond market has reacted a bit negatively, but I don't think it's because of the tariff story, but rather just because you've got a lot of Treasury supply coming in the first part of this year. You've had inflation that's been higher than expected. You've gotten the Fed that has been pretty dovish, and that's led the market to add risk premium in the long end. So the reasons why the long end and the Treasury market broadly has sold off, I don't think it's related to tariffs, though.
But Joe, you just said it, the market potentially, in your view, rallying because they think inflation's coming down. That could be a sign that the market was happy that Trump's tariff policies could be more limited because there's concern that those policies will be inflationary.
Yeah, I don't think it's, I know, no, the tariffs to me are not inflationary. The tariffs are part of a comprehensive program that includes increased energy production, as you were highlighting, deregulation, which can increase the supply side of the economy, and of course lower taxes. So that four-pronged approach, so to speak, will get the economy moving, get growth to be faster. And that to me is what the equity market is discounting. The equity market is discounting what should be a very good year for growth in 25, and hopefully concentrated more in the private sector than in the public sector, which, by the way, in the last 7 quarters, the public side of the economy has grown faster than the private sector, which is really unheard of and unnecessary. So if the programs coming in, DOGE, et cetera, can deal with some of this excess government spending, that'll also go a long way to leading to faster or better animal spirits. And I think the equity market certainly is factoring that in as well.
Joe, when you take a look at the bond market and the reaction really that we've seen since that first cut going back to the fall, it's been pretty steady in one direction to the upside here. When you take a look at yields, the current rate right now on the 10-year yield, how much higher could we potentially see? And I guess at what point does that become a bit problematic here for growth?
I mean, right now rates are pretty high. We think they're above where estimates of fair value have them. Unfortunately, the Treasury's decision to shorten the average maturity of the debt does pose some problems in the sense that eventually that debt will need to be termed out. I'd say there is a risk that 10-year yields could move higher, perhaps make a move up to 5%. But if inflation's coming down and we've got very good growth, close to 3%, if not better, we look at the first Trump 1.0, we had low rates and good growth and low inflation. So I don't think rates are sustainably going to be higher here, but it's not to say in the short term we can't get a move up. I also think a lot will depend too on what the Fed does. I mean, the reason why the market is sold off is if you look at the term premium after that 50 basis point cut back in September has explained the bulk of the sell-off in 10-year yields. And the fact that Fed imprudently cut in November and December is a reason why these yields have risen, why the yield curve has steepened. The Fed cut when it shouldn't have.
Really quickly, want to get your take on this reconciliation bill. Speaker Johnson saying that it could be passed by April. When do you think the market should anticipate getting policy clarity from the incoming administration? Should it be in April?
Well, President Trump said he wants something on his desk in May, and that'd be right around 100 days from when he took office. So I think that's very doable. And I like the fact that there's going to be one big bill. I think that makes a lot of sense as opposed to breaking it up. So I'm optimistic that we can get it done, whether it's April, great, or May. I mean, that really won't matter.
What happens if it's 2 bills, though, Joe?
Well, right now, President Trump has said he wants one bill.
Yeah.
And Jason Smith, who heads up the Ways and Means Committee, said we can write the tax stuff. We've been working on it, and we can get it in one bill. So to me, it looks like it's going to be one bill, which to me is the more prudent way to go.
All right, Joe, thanks so much for your time. As always, great to have you here on Yahoo Finance.